Hi, welcome to this short video on commercial real estate investment strategy. Thanks for watching. So you've made it to the end of the pro forma. The next step, using it to enhance your investment strategy or to understand how to enact your investment strategy. What I've got on this slide are 5 key ways that investors use debt or tax strategy to enhance their returns or to implement a specific real estate investment strategy. Now, it's tempting to want to just skip to this video and say, look, Jeremy's got 5 ways that we can manipulate our real estate investments and pick 1 or 2 that you think will make you more money. However, unless you know the ins and outs of the pro forma, it may be the case that these strategies don't work for you. So that caveat there in yellow is really important. The only way to know which strategy works for you and your investment is to actually run the pro forma and evaluate the scenarios based on your expectations of the market and your expectations of the performance in the income producing capacity of that investment that you're considering. Now that said, here's the areas in debt and tax strategy that you can take to manipulate those equity returns. Remember that we're really focused on debt and equity strategy because manipulating your NOI or strategy that involves increasing NOI is quite difficult because NOI is largely based on prices determined in the market. And a single investor rarely has any influence over those cash flows. So where investors really have a lot of influence on the returns is the strategies associated with debt and taxes. On the debt side, previous videos have talked about leverage. Leverage is the ultimate way for an investor to play with the risk-return profile of that investment. And we know that increasing our leverage, going to the highest leverage we can take, is a great strategy if you're a risk-seeking investor, because that leverage will enhance those equity returns, again, assuming that leverage is positive, and you need to run the pro forma to understand whether the leverage is positive, and assuming that everything goes as the pro forma expects. Remember, pro formas are always optimistic. They always look good. You never go into an investment with a bad pro forma from the start. So understand downside risk assumes that things don't go as planned in the pro forma, but there's also upside risk. It could go better than planned in the pro forma. So leverage is enhancing the effect of those unknown, uncertain future risks on your returns. Positive upside risk will really inflate your returns if you have high leverage. Negative downside risk occurring will greatly deflate your returns or even create losses in the event things don't go as well as planned. So it's a decision. How much risk do you want to take on? What's your capacity for handling any downside risk that occurs? We don't tend to worry that much about the upside risk. Now, amortization. Another thing. You can go into a lending negotiation and say, I want interest-only loans. And as you can see there, I've used the Orwellian less is more. Now, the less amortization we have, the less principal we're paying off over the term of the investment, the lower those service payments are on the debt, the more money we have in equity before tax cash flow for every period. Now, again, less amortization means a bigger balloon payment at the end, but especially if we're a value-add investment, we expect to make a lot of money at the end. So we want the least amount of payments we can have now with the expectation that we can make everything good for the lender at the end. So in general, the less amortization, the more our returns are affected at the beginning, which from a time value of money perspective is the ones that make the biggest difference to our NPV. So we always want less amortization versus more. Now remember that if you start going into negative amortization, if a lender even allows it, you'll be inflating that balloon payment over time, and that generally is not a great idea because of the effect of compounding interest. Right? That'll start reducing your returns right away as well as giving you lower payments. So again, key thing here, pro forma, pro forma, pro forma. And why do I stress running these models, or what you can get from your lender in the pro forma, because of what I say in the what to watch for. Remember, taking on more leverage increases risk, not just to you, but also to your lender. If you're not able to pay the lender has to initiate an expensive foreclosure proceeding and may not recover the returns that they expected. So as you increase your leverage up to that max, you might start exceeding their underwriting limits, and they'll be charging you higher and higher interest rates. Those higher interest rates might offset the benefit that you get from taking on higher leverage. It's only a question you can only answer by investigating what the pro forma looks like in the two scenarios. Again, the less you amortize it, the bigger the risk the investor takes on in terms of the payment and their return at the end. So, to protect their risk and to cover the cost of taking on that additional risk by the lender, they might charge you higher interest rates for an interest-only loan, or a partially amortized one that has a longer amortization term. Again, how do you tell which one is better? Well, run it through the pro forma. So, while you want less amortization, it may be offset by higher interest rates. So that's on the debt side. What about tax strategy? Well, we're going to do an exercise in class, and partially part of your homework, on whether you would advocate for Congress to give you high depreciation allowances, or for Congress to be nice with their capital gains tax rates. For investors, that's often a difficult decision. And we'll look at the type of investors that benefit from depreciation allowances or capital gains tax, and whether there's kind of a general outcome like debt leverage and debt amortization that applies to most investments, and what to watch for. Tax shelters. We love making money from negative taxes, especially if we have income that can take advantage of those taxes. So I gave you in the after-tax cash flow example of what I call negative gearing or negative leverage, where we actually have positive equity before tax cash flows, but the deductions that we get from interest and depreciation exceed our NOI, which means that we have negative taxable income, so our equity after tax cash flows are actually higher than our before tax cash flows. Looks great, right? We make more money by losing some money. So if you can profit that way, great. It's a strategy used by a lot of Australian investors that seek capital gains, or other investors that are seeking capital gains and don't care that much about the income returns, saying, well, if I can shelter some tax somewhere, great. But that may not be you. So make sure to understand the effects of negative leverage, and remember that when you have negative gearing or negative leverage, you're also fiddling really close with not being able to meet any debt payment if you have debt. So while you might have negative, might look good on the pro forma, a slight decrease in that NOI may mean that you have to raise or call for extra equity to make the project salient and continue, solvent and continue. Finally, exit strategy. Now I've got a whole next slide on options for exit strategy. Now that involves deferring a capital gains tax event, and it's of great interest to investors, especially nowadays, with Congress really trying to innovate and use that as an incentive for real estate investment. Now, pursuing tax strategy, what should you watch for? Basically, pursuing tax incentives blindly, and remember, tax incentives generally tend to restrict the type of investment behavior or options. They're designed to influence your behavior. Now, if the restrictions that qualify you for any kind of tax relief restrict your ability to earn income or capital returns, well, then maybe it's not worth it. Again, only the pro forma can tell you if a tax incentive really enhances the value of your project, or it might actually destroy the value of your project because you constrain either the tenants or something related to the building that actually reduces your returns. So make sure you don't just blindly pursue tax incentives. I've seen so many investors do that, and it doesn't generally end up that well. They may make some money, but when you tell them they could have made more, well, they're generally not as pleased. So let's talk about exit strategy. So, one of the key tax events, especially in the example you saw in the last video on after-tax cash flow accounting, is that capital gains tax can be a really big negative cash flow. So, are there any options to reduce or perhaps even defer that capital gains tax event? Now you might say, okay, defer it. Well, isn't that happen when I finish the holding period? How can I defer it later? Well, we've generally looked at sales being the only way out of an investment. So we've modeled real estate investment as a decision where you acquire an asset, you hold it for a defined period, and you sell it at the period, and that sale is generally modeled as our reversion price, or what we sell it to another investor. Now, a sale event triggers capital gains tax, and that is what we've covered in the previous lectures on tax. What are your other options? Well, you can refinance. So, let's say you don't mind holding the asset for longer, but you did a value add to the building, and you added value. It succeeded. You have a lot more income. The appraiser is appraised it with a big high capital gain, and you want to extract some of that equity and do another investment or do another value add. Well, in that case, you can look at refinancing it. Remember that lending is based on two key underwriting variables, loan-to-value ratios and debt coverage ratios. In your improved asset, you probably you're well under that, so you can go back to your lender and say, hey, look, we've got this asset stabilized at a much higher NOI. My debt coverage ratio is 3 or 4 or whatever, and you're willing to accept 1.5. What if I increase my loan to cover, to get closer to that limit, have a bigger payment obligation, but because of my higher income, it works. So if I refinance it, yeah, there's costs of refinancing, but I haven't sold the asset, so there's no capital gains tax event. So I can extract that equity and do another investment while actually still holding on to the initial investment. Now, let me get to the next two, which are very specific to the United States. The first one is called a 1031 exchange, or if you see 1031 ever used as a verb in real estate, this is what they're referring to. It refers to an event where you sell an asset and then immediately, and I think the period is 45 days, within 45 days, you invest all of the equity and the gains that you earned from that original investment into a like-kind other real estate investment or a similar property. Now, what that does is it defers the capital gains tax to whenever the tax event on this second or subsequent properties, right? You can do an infinite 1031 chain to never pay capital gains tax as long as you remain a commercial real estate investor. And therefore you'll never have to pay capital gains tax, or you can at least defer it. Now, remember that as you defer it, your obligation increases because your cost basis doesn't change. So that's very specific to the United States, and if you ever get in that situation, I encourage you to consult with an expert in that area to get the finer details of how you do it. And the last opportunity is called an opportunity zone, which is a tax incentive recently passed by Congress in 2017, which is very similar to a 1031 exchange, giving restrictions on what you can invest your gains in. Now, the key thing here is that you only have to invest your gains in, excuse me, in the new investment, not the equity and the gains that you originally invested, which is the case in the 1031 exchange. And so what an opportunity zone says is it restricts where you invest those gains. So not only do you have to invest it in, well, actually it doesn't restrict on what you invested in. You can actually shift from property to investing in a business. But the location of your new investment has to be located in what Congress has identified as opportunity zones, which are generally low-income areas as defined by the U.S. Census, where Congress would like to see more investment activity by the private sector. So if you take your gains and invest them in a fund that qualifies as an opportunity zone, you can then defer or perhaps even waive, given how long you stay in that investment, in the opportunity zone, all capital gains tax. So that's a quick view on strategy. Thanks for watching.